Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. Risk disclaimer. True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified Elliott Wave analyst, having earned my Level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott Wave theory. In addition to my work as an analyst, I'm also an author and educator. I wrote Introduction to Elliott Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. So, these are the main topics that we are going to cover inside today's webinar. Let me talk about macroeconomic events and data releases. I'm going to cover previous week fundamental analysis, previous week global market trends. So the first one is the GDP month over month related to Canada, and the next one is the non-farm employment change. Okay, what is Canada's GDP M over M? M over M stands for month over month. Canada's gross domestic product GDP is a key economic indicator that measures the monthly change in total value of all goods and services produced within the country. It serves as a real-time gauge of economic performance, indicating whether the economy is growing or contracting. Published by Statistics Canada, the report spans a wide range of industries, including manufacturing services, construction, and energy. Given Canada's reliance on commodities, the GDP figure is especially sensitive to fluctuations in global demand and prices for resources like oil and natural gas. A positive reading signals economic growth, while a negative figure suggests contraction. Forex traders and market analysts and policymakers closely monitor this release to assess the health of the economy and anticipate potential adjustments in the Bank of Canada's monetary policy. Now, on July 31st, the previous number was 0.1%. The forecast was also minus 0.1%, and the actual data release is also minus 0.1%. Now, the market expectations and the reaction is the actual GDP reading match both the forecast and previous figure, showing a second consecutive month of slight economic contraction. While the result was not worse than expected, it confirmed ongoing economic stagnation, likely tied to weak um, uh, economy. Okay, and the weak domestic demand as well, sluggish industrial performance, and continued pressure on commodity exports. Despite the lack of surprise in the headline number, USD-CAD moved higher. Let me show you the chart of USD-CAD as well. So let us take a look at USD-CAD. So this is the USD-CAD currency pair daily time frame, and over here we got the news on July 31st, and price action actually moved up. This reaction suggests that market participants interpreted the steady negative reading as a signal of lingering economic weakness, possibly increasing the likelihood of future BOC rate cuts. The move in USD CAD reflects renewed strength in the US dollar relative to a softer Canadian dollar. Now, the potential market impact on USD CAD is that GDP is in line with the expectation. The expectation was minus 0.1%, and the actual number we got is also minus 0.1%. While no surprise in the data, the repeated contraction adds weight to bearish sentiment towards the Canadian economy. With inflation concerns easing and growing, stalling, the BOC, the Bank of Canada, may lean forward towards monetary easing. This outlook has contributed to Canadian dollar weakness, pushing USD CAD higher. The overall analysis is the GDP result reinforces concerns that Canada's fragile growth momentum. With two back-to-back months of contraction, the previous month was minus 0.1%, and then we got again minus 0.1%. So these two back-to-back months of contraction suggest the pressure is building on the Bank of Canada to consider further easing measures to support economic recovery. As a result, the Canadian dollar weakened and USD CAD saw upward movement post release. The conclusion is, although the GDP reading did not surprise, it confirmed a worrying trend of stagnant growth. Market participants reacted by pricing in greater odds of Bank of Canada dovish, leading to Canadian dollar softness. Going forward, traders will be watching upcoming inflation and labor data for more clarity on policy direction and USD CAD trends. The next one is the non-farm employment change related to USA, and the euro dollar is the most affected currency pair. Now on Friday, August 1st, we got the US non-farm employment change report. This is also known as non-NFP or non-farm payroll data report as well. The US non-farm employment change, commonly known as non-farm payroll or NFP, tracks the monthly net change in employment, excluding farm workers, government employees, and those employed in private households or non-profit organizations. This critical labor indicator is released by the US Bureau of Labor Statistics and provides a direct signal of the nation's economic strength and hiring trends across major sectors. NFP is a key input into monetary policy decisions and one of the most closely watched economic reports globally. A strong number generally supports US dollar strength as it suggests economic expansion and potentially tighter Federal Reserve policy, while a weak number can have the opposite effect. Okay, now the previous number was 14K. The forecast was 106. and the actual number we got is 73K. Now, the market reaction and interpretation, let's talk about it. And let me also show you the chart of euro dollar. So this is the chart of euro USD currency pair, and over here in daily time frame on Friday after the news release, we got this 200 pips bullish leg inside euro dollar currency pair. We'll talk about euro dollar analysis as well later. The actual print of 73K came in well below expectations of 106K, but showed a recovery from the prior month sharply disappointing 14K. The previous month we got 14K. The, this time we got for 73K. While still positive, the figure indicates continued softness in US job creation, suggesting the labor market is slowing more than forecasted, yet not collapsing. The immediate market reaction saw Euro USD rise, signaling broad based dollar weakness as traders recalibrated expectations for US monetary policy. This upside move in the euro likely reflects growing sentiment that the Federal Reserve could lean toward rate cuts sooner than previously anticipated, especially if further data continues to show labor market deterioration. Now, the weaker than expected NFP adds to a string of soft US economic data, raising questions about the durability of the post COVID expansion. Slowing job growth combined with easing inflationary pressures could open the door for a more dovish Fed stance in the coming months. This 73K print reinforces concerns about reduced consumer spending capacity and signals potential weakness in forward looking indicators like ISM services or retail sales. In this environment, Forex investors may seek safety in euro dominated assets or anticipate ECB catch up policy if the US begins to pivot dovishly first. Now, the potential market impact we got on the euro USD is well, the expectation was that we might get a 106 number or greater than that, um, but we got a 673K number. So people were thinking that we might get a surprisingly strong reading of 106K. That would show a robust market resilience, possibly reinforcing expectations for tighter Fed policy. This would support the US dollar and likely push the euro USD lower, especially if wage growth also surprises to the upside. But what happened is that we got 73K result, which is a disappointing figure, increases the probability of future monetary easing. It raises red flags about slowing economic momentum in the broader economy and could weaken the US dollar, pushing the euro dollar currency pair higher as risk sentiment shifts. So overall analysis is with the Federal Reserve adopting a data dependent approach, this weaker than expected NFP report may weigh heavily on future rate decisions. While not alarmingly low, the shortfall confirms that labor market momentum is cooling, possibly leading the Federal Reserve or the Fed to shift its tone in upcoming meetings. For euro dollar traders, the market shows us a key inflection point. And if additional US data such as wage growth or CPI also softens, the euro dollar currency pair could continue to rise up more against the dollar in anticipation of policy divergence. So the conclusion about the NFP is the July NFP report disappointed expectations. The expectations was 106K, we got a 73K, but showed a modest recovery from the prior month. The prior month was 14K. As a result, Euro USD currency pair moved higher, reflecting US dollar weakness and renewed market hopes for Fed policy easing. Traders should watch closely for follow up labor market indicators and inflation data to confirm whether this was a temporary slowdown or part of a broader economic deceleration. Until then, Euro USD could remain supported as markets adjust to the possibility of a more accommodative US policy path ahead. Next, let us talk about the previous week global market trends. We're going to discuss the euro dollar and US dollar Swiss franc. Okay, first one is the euro dollar. Now, we got a bullish leg in euro dollar. I can see this thing, but it bounced from this old support area and price was, somewhat overbought as well. So we got the decline and then market was turning almost oversold. Based on this technical analysis approach, price action usually find aggressive buyers around the old support area. Due to this reason, we got this bullish leg. Now, the way I see the euro dollar is probably going to drop more. Okay, it could drop and bounce back up again from this level as well. So a good idea is to wait for the price action to break below the support level one more time. Okay, next one is the US dollar versus Swiss franc. So if you check out the daily time frame, Swiss franc just keep going down, down, and down. However, it's trying to rise back up again. If you check out the 4-hour chart, market is again trying to push higher. We got this big washout on Friday due to the NFP, the drop in USD Swiss franc. It shows us that the DX is becoming weak and the Swiss franc is becoming strong, but market is now going back up again. Next, let us take a look at macroeconomic events and data releases for the current week. So for the fundamental analysis, this is what we're going to do. The number one is the construction PMI related to UK, and we will get this report on August 6th. Next one is the unemployment rate, Canada, and we will get this report on August 8th. So what is the construction PMI? The construction PMI, constructions is one word, but the PMI stands for Purchasing Managers Index. It's a leading indicator to economic activity in the UK construction sector. It is based on a survey of purchasing managers across the construction industry, measuring business conditions including employment, output, new orders, and supply chain dynamics. A PMI reading above 50 signals industry expansion, while a reading below 50 indicates contraction. This data is closely monitored by traders and analysts, and the construction sector represents a significant portion of economic activity and is sensitive to interest rates. Okay. Business confidence and overall demand. Now the key figures is the previous number we got is 48.8 and the forecast is 49.2. The actual data not released yet. The previous reading we got is 48.8, indicated a mild contraction in the construction sector of United Kingdom. The forecast for August suggests a slight improvement to 49.2, though still below the 50 threshold that separates growth from contraction. Now, the market implications for the GBPUSD is, let me show you the chart of GBPUSD as well. This is the chart of pound dollar currency pair. Okay, price action is going down overall. The construction PMI report is especially important now as market assesses the broader health of UK economy amid ongoing uncertainty over interest rate policy and inflation trends. Number one scenario is we get a PMI reading and it goes, above than 49.2, or maybe we get a 50 number. So the interpretation of that number would be a stronger than expected number could indicate stabilizing or recovering demand in the construction sector, and the impact on the pound dollar would be, likely you get a bullish lag in GBPUSD currency pair. Traders may view this as a sign that economic momentum is picking up, possibly delaying future Bank of England rate cuts. This scenario number two is the PMI matches forecast. The forecast is 49.2. That's the number. So a result aligned with expectations would confirm modest improvement, but still signals contraction, and we might get a limited reaction in GBP/USD currency pair unless accompanied by unexpected regions or strong sub-index components. The scenario number three is if we get a PMI number below the forecasted level, below 49.2 number, or we might get even a lower than that number, then this means a weaker reading would suggest ongoing stress in the sector and could reinforce a bearish view on UK growth. So the impact on GBPUSD would be a likely negative for GBP, especially if the result drops further below 48.8, signaling deeper contraction. So the conclusion is until the actual data is released, GBP USD may remain in a holding pattern, with Forex traders cautiously positioning for possible volatility. A reading above 50 would likely be seen as a major positive surprise, while a drop further below previous levels could heighten recession fears and put additional pressure on the British pound. As with all PMI releases, the tone of the accompanying report and comments on future expectations will also influence market sentiment. The next one is the unemployment rate related to Canada, and we're going to discuss USD-CAD currency pair. August 8, 2025, that's the date. Now, what is the unemployment rate? The unemployment rate measures the percentage of Canada's labor force that is unemployed but actively seeking employment. It serves as a crucial gauge of economic health, providing insight into job market dynamics and the broader performance of the Canadian economy. The Bank of Canada pays close attention to labor market data when determining interest rate policy. A declining unemployment rate typically signals strength in the economy and may prompt the Bank of Canada to maintain or tighten monetary policy, which tends to strengthen the Canadian dollar. On the other hand, a rising unemployment rate suggests economic weakness and may lead to rate cuts, weakening CAD and pushing USD CAD higher. So, August 8th, 2025, the upcoming unemployment rate data numbers are the previous number we got is 6.9%, the forecast is 7%. The actual data not released yet. Now, the market expectations is that the forecast shows a slight uptick. Let me show you the chart of US dollar versus Canadian dollar over here. The forecast shows a slight uptick in the unemployment rate from 6.9% to 7%, reflecting concerns over slowing hiring momentum or sector-specific job losses. Markets are cautious ahead of the release as the data could significantly influence the short-term direction of USD CAD. Right now, the USD CAD is going up. Now, let me talk about different market scenarios. Potential market scenario for USD CAD number one is unemployment rate is lower than expected. We get less than 7% number. Lower than forecast reading would signal a stronger labor market than anticipated, reducing pressure on the Bank of Canada to ease policy. and the CAD is likely to strengthen on the news, pushing the USD CAD lower, and we might get a drop in price action as traders price in a more resilient Canadian economy. The scenario number two is unemployment rate matches the expectation, the 7%. And if we get 7% unemployment rate on August 8th, then that number is in line with forecast and may lead to a muted market reaction unless other components of the labor report, such as wage growth or participant rate, show surprises. So expect a sideways price action, some kind of a range bound type situation. The scenario number three is unemployment rate is higher than expected. We get a greater number, meaning the unemployment rate is going to increase even more than 7%. A higher unemployment rate would suggest labor market deterioration and may boost expectation for Bank of Canada rate cuts. So CAD could weaken, leading to USD CAD moving higher as investors' confidence in Canada's economy as uh, the investor confidence in Canada's economy decline. So if we get a higher number like 7% or greater than 7% unemployment rate figure, then that's bad for the Canadian economy and expect more upside in USD CAD currency pair. So the overall analysis is this unemployment rate release comes at a sensitive time for Canadian markets. Inflation has shown signs of easing and growth momentum is mixed. As such, labor market data could tip the balance in terms of how the Bank of Canada approaches future policy decisions. Given that the forecast anticipates a rise in unemployment, an upside surprise could sharply boost the CAD, while a downside surprise, higher than expected rate, may trigger renewed weakness in the currency. So the conclusion is until the data is released, the USD CAD may remain in consolidation mode driven by broader risk sentiment and positioning ahead of the event. However, a meaningful surprise in the unemployment rate, either higher or lower than expected, has the potential to trigger sharp intraday volatility. Traders should prepare for increased movement around the release time and consider the broader economic context when assessing the implications of the result. Okay, next, let us take a look at current week market trends. We're going to discuss the euro dollar. Okay, go to the euro dollar. So right now, the euro USD currency pair is trying to drop over here. So we might get a retest of this support area. If we go to a 4-hour time frame, this was a big bullish move we got over here. And so far, it seems to me price action is trying to drop, and we might get further weakness in price action. Okay, let me change the color of this trend line to red. So we might get further weakness in price action of euro dollar currency pair, at least on a short term basis. Next one is the British pound, GBP USD currency pair. Okay, GBP USD daily time frame. So we got this bullish leg over here. This is where we got basically the support over here. You see, and market tried to bounce back up from the support area. If price action is going to fall again, let me delete some of these trend lines. So if price action is going to drop again, then obviously it's going to break below this support area. So we will see if market is going to revisit this support area or not. However, if market is going to start the rise, then expect more upside. But the way I see, market is probably going to drop more over here in GBPUSD currency pair. Next one is the US dollar versus Canadian dollar, USD CAD currency pair. So the daily time frame, let me zoom out a little bit. This was the bearish trend channel, and then we got a breakout. And this was a retest down over here. Okay, this is where we got a retest. And then from these lows, price action rallied up again. So I expect more upside in USDCAD. However, I discussed the different scenarios related to financial news. So we might also get some sort of a sideways price action or a reaction in market. Next one is the spot gold. Okay. XAU USD pair. Let us take a look at a weekly time frame. The weekly trend is obviously up. Price action just keep going up over here. It's a nice uptrend going on. If you check out the daily time frame, we got this breakout to the downside. And last week I told you guys that this breakout is probably going to fail. Price action is going to rise up. So we got the push to the upside above the trend line. Now market is probably going to start the decline. Let me, okay, you adjusted the trend line over here. Okay. So if price action is going to drop below this trend line again, then I expect further weakness in price action. Okay, if you have any questions at the end of this session, feel free to type inside the chat box and I will be happy to answer your questions. So what you have learned today, we discussed about the construction PMI related to UK and the GBPUSD currency pair. We also discussed the unemployment rate in Canada and the USDCAD scenarios as well. We also talked about the euro dollar, GBP USD, USDCAD, and support gold. These are the assets you need to watch out for profits. What you should do next? Well, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. And if you want to learn more about trading, visit TradeGeek and access free trading courses for beginners, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, August 12th, 2025 at 12 p.m. UTC time. So from my side, have a nice day and bye-bye.